themselves. Okay, mailbag item number 3, Andy. Let's do it. This one comes from Australia. So Colin Anderson writes in, Dear Motley Fool team, since joining Motley Fool Stock Advisor and Rule Breakers in the U.S. and Stock Advisor and Dividend Investor here in Australia, all Motley Fool services, in the last 4 years I've become an educated, enriched, and entertained investor. I'm especially, he's going to keep going with the alliteration here, I'm especially wiser, wealthier, and he writes well-prepared for market volatility. During the recent bumpy ride through the past few months, I've slept well, been quite relaxed, but a little sad that my liquidity didn't allow me to buy more in the dip. Now, he didn't write on the dip. I think here in America we'd say buy on dips, this sort of thing. But this is maybe an Australian English approach here, buying in the dip.
Could be.
We'll get back to that in a little bit. Let's continue. Your services point me towards better companies, better investing, and a better future. Thank you for all the fantastic services. Now to my question. I used to wait until I accumulated about $5,000 before investing in any stock. That was the limit my old broker set before bumping his charges from $50, that's a commission rate, right, to 1% of the purchase price. Ouch. My new broker now charges, this is the better world we're living in now, $15 flat. Still high by U.S. standards, but better. Certainly, we agree, right?
Yes.
Yeah. Now, thanks to some great tips from you all, I've started to dollar cost average my entry into a new stock. I think we just talked about that. Regular investment, adding to winners. In my old style, I bought bigger chunks and often added to my weeds as I tried to lower my average purchase price. I lost bigger than I would have lost in this foolish style of investing, but even with your sage advice, I've only learned the painful lessons of watering weeds this year. I've recently started small positions in Intuitive Surgical, Shopify, MongoDB, PayPal, and JD.com. I've added to Shopify and MongoDB. Now the recent slide in the market has opened up a question. Do I buy, here it is again, Andy, in the dip? Or would I be watering my weeds again? In my specific case, for these current stocks, the ones I just mentioned, Intuitive Surgical, etc., I have confidence in these companies. The reasons for selecting them have been all caps foolish, not small f foolish. The market drop has been a vote against the broader market. I've seen nothing against the weight of these companies, but how do I recognize a dip or distinguish it from a developing weed? Yours foolishly, Colin Anderson. So, Andy, I laid a lot of scaffolding there. Colin shared where he is in his investment journey, but fundamentally the question is this. When a stock drops that we like, how do we know whether it's just dipping and going to come back or one of those weeds that you don't want to keep watering?
Well, it's a great question, Colin, and it's this making the distinction between truly watering your weeds. And when we say weeds, we mean, I think, at least I mean, and I hope Colin means this as well, companies that have the stock prices lower, and in fact, maybe the business has deteriorated a little bit, and it's a smaller part of our portfolio, so we are dollar cost averaging our price down a little bit.
A lot of people do that.
A lot of people do it.
But Andy, you and I know the reason we call them weeds is those are the ones that you shouldn't have done that to.
That's exactly right,
Don't want to
David.
water the weeds.
You don't want to water the weeds, and the other part of that saying is water your weeds and trim your flowers. You actually want to water your flowers because those are the businesses that are going to continue to hopefully win in life and support the great things they are doing around the world, and also that is good for shareholders. So supporting those businesses and investing your capital, your hard-earned capital, Colin, into the businesses that are doing well. Now, to your question, the difference between watering weeds and watering businesses like Intuitive Surgical and Shopify that have gone down, that have pulled back. The first thing I would say is that has the market pulled back in general? So is whatever general market index you look at, and you certainly look at the last couple months, the S&P 500, the most general market followed here in the U.S., different obviously around the world and different in Australia, the ASX 200, whatever it might be, the general market has that pulled back as well, and have my stocks pulled back with that. So first of all, that's the first thing. How is your business compared, your stock performance against the general market?
If the whole market's selling off and your stock's with it, that probably doesn't indicate they're weeds.
Not by itself, it certainly does not.
Right, the whole market's sold off.
That's right, exactly. So that's the first thing. Second thing is then look at the performance of your businesses. Certainly go in and just see. You can go into the motleyfool.com, fool.com over in Australia, and pull up a ticker to see if the business continues to grow. If the business seems to be doing continuing to do well as Intuitive Surgical is, as Shopify is doing, as so many of our businesses continue to do, then I would see that as an opportunity to add on that weakness on price, but hopefully you're adding on the strength of the business, and that's the difference.